for other academics like me. And so you see there two books, one on digital transformation. The second one in the middle, it's on innovation that was published by The Economist. And you see there is another one, which is almost ready. But when a professor says almost ready, it means it's not ready, but the book is there. I need to do one final revision and then it will be published early next year. And you will see this last book is really on the disruption of financial services. So if you want, I'm happy to discuss some of those things with you. I also want to say one final thing before I introduce the session and we start. I would like to say, you're not here for me, I'm here for you. So if there is anything that I say that you don't understand or that doesn't make sense or I don't explain myself clearly, please ask me to repeat. Or if you want to share your perspective, a comment, what things mean to you, what's your experience been, again, please feel free. Actually, the more I hear from you, the more I can adjust my presentation to make sure that it's relevant and interesting. I know there are participants from different sectors, different backgrounds. Some of you are also from academia. Some of you are students, I suspect. So I will try to keep the level approachable and accessible to different audiences. I prepared a lot of material, and even so, it's not enough for the topic of today. But don't worry, I'm not going to cover everything, but there are 4 big points that I want to cover because I want you to understand why are we doing this. What I want you to go home remembering, or disconnect from the webinar, I want you to remember. The first one is that when we talk about these new technologies applied to the world of finance, it's not only about the technologies. And we will talk about them. We'll talk about AI, we'll talk about blockchain. Yeah, but the truth is that what is changing, thanks to the technologies, and it's further pushing the change, what is changing are the players. Number one, who is a financial service provider in 2023? Well, we will see. We will discuss that. There's more than one, and they're not only the traditional ones. In fact, the less traditional ones, the non-incumbents, so to speak, are the ones that are bringing the more interesting changes. Then, of course, the technologies. Yes, we will talk about AI a little bit. We'll talk about blockchain a little bit. But mostly, even after we explain these technologies, what really matters, even more than the technologies, is the change that the technologies are bringing to finance. So, and we will discuss, I think I selected 6 important, impactful trends that are really important right now, in 2023. There's more. There's always more things happening, but these are the 6 that I believe are the most important right now. And so if you have any additional comments, maybe you heard about other trends, please let me know. And finally, point 4, it's really just a takeaway. Point 4 is maybe one slide, so it won't be the longest part of the presentation. I think we will take more time on parts 1, 2, and 3. And then when we get to point 4, good news, we're done. All right. Listen, I hope that you can hear me well. I don't think I can see the participants right now. If anybody can give me a sense of if they can follow, if I speak too fast, too slow, if everything I say makes sense, if there is any question, please let me know. So I would like to start, and I will start exactly by telling you something about what we call today fintech. Okay, fintech comes from the combination of the words financial technologies. But when we talk about fintechs, usually we don't talk about technologies, we talk about startups that use such technologies to transform the way we do business in the financial sector. So the way they operate their business models. So we start with the fintechs. Listen, there are maybe 3 big waves of the arrival of technology to the field of finance, okay? The first one was the first wave of financial globalization made possible by communication technologies. So the telex, the communication technologies of 2 centuries ago, the early last century. The second one, the second wave, was a wave of new digital technologies, but driven and launched by corporations, or in some cases, large banks. Okay, for example, the SWIFT platform, the protocols to make international transfer, online banking, driven by large banks. The last wave, the one we're discussing today, is a wave of digitalization driven especially by new startups. And that's why when we talk about fintechs, we don't really talk about the technologies, we talk mostly about the startups themselves. Now, why is it important to understand the startups? What makes it important is because in the financial services sector, or in the landscape, there are many large incumbents, large banks, large insurance companies, large payment providers. And they seem to look especially at each other. I am MasterCard, I look at what Visa does. Yeah, I'm a large bank, I look at what competitors do. But the truth is, it's very rare that one of your direct competitors is going to put you out of business. In a different sector, I'm sure you've heard about what we call the cola wars, the war between Coca-Cola and Pepsi. Coca-Cola and Pepsi have been fighting with each other for decades. Do you think that one of them is going to put the other one out of business? Because I don't think so. If that was going to happen, it would already have happened by now. But that's not what really happens usually. It's not like large corporations put other large corporations out of business. You see in this slide, I use this funny way of describing it. If you're a large Godzilla, it's not a large King Kong that's going to threaten you, and threaten your survival. Because the kind of innovations that change the way we do business usually come from smaller, more innovative startups. And the threat of these startups, even though many of them are small, is that there are many of them. I want to give you an idea of what is happening, what is the biggest strategic move, the most common strategic approach of fintech startups, so that so you see, you will start thinking, hey, this is changing the rules of the game. So we start with that. And I start by showing you a bit of a messy slide, but I'm now going to zoom in and show you what this slide represents so that we understand better, because right now it's very, very confusing. This comes from a consultancy and a research and consultancy company called CB Insights. You will see I have quite some references from them, this is the oldest, 2017 until 2023. I keep going back to them because they are a very, very good provider of interesting strategic insights in many companies, especially in fintech in this case. So I'm saying this to you because after the session is over, maybe you want to find more information. That's a very good source. Okay, what does this mean? What does this slide mean? I'm going to zoom in a little bit. Yeah. Now, what you see I hope you can see the red square. The red square, this item in there, is the website of an incumbent, a traditional bank, Wells Fargo. And when you start looking a bit closer, you see that there are many tabs. Yeah, this is personal banking, for example, loans, insurance, investment, wealth management. And if you go down, there's more. Money to go to college, money to buy a house, investment. Then you probably find payments, you find credit cards, financial education. You find all sorts of services provided by this bank. In other words, each one of these tabs represents one element of the business model of the bank. Okay? So traditional incumbents in financial services usually provide a very rich business model with many services. What do fintechs do? The majority of them, let's say almost all of them, start by offering only one service. I'm going to zoom out again. Yeah. Each of these icons you see here, each one of them is one fintech startup. And you see that the arrow points in the direction of the one service that this startup provides. For example, there are many of these startups you see on the right. They provide financing when you buy a house. Yeah, you have some other here. They provide loans and credit. Here they provide investment and retirement. Anyway, long story short, most fintech startups start their strategy, their activities with a strategy to provide only one service. We call this approach unbundling. Unbundling, what does it mean? It means that I take a bundle of services from the business model and I break it apart and I only do one thing. This is difficult to respond to for a bank because at the end of the day, these startups only do one little thing. Whereas your business model of a big bank is very rich. You have many other areas. So it's difficult to say, oh, let me respond just to this. I want to highlight that this is happening in banking. Of course, it's happening in insurance. Yeah, housing insurance, car insurance, life insurance. It's happening in other payments, in other financial services. So this is, for example, is payroll, just paying salaries. Yeah, same thing is happening there. So it's happening also across industries. It's happening in education, in fast-moving consumer goods, in hospitality, you name it. Everywhere you see this game. But today we're going to talk about fintech and financial technology. So the only examples I give you are like this. Now, when you are a large incumbent bank and you see these little startups coming to do a little part of your business model, it's very difficult to take them seriously. And to be honest, the majority of them fail. Anyway, we know that startups tend to fail. They fail in huge numbers. Usually the problem is not the ones that fail. The problems are the very few that don't fail. So even though we believe that we as incumbents, as a successful established bank, I believe that startups will not succeed because they don't have a brand, because they don't have an understanding of a regulated industry, because they don't have trust, they don't have presence, they don't have management, all of those things. They are all true. In the long run, some of them will find a way to do things right. They will survive and they will start growing. And when they start growing, but they have a different approach to doing business, doing financial services, what happens is that the industry changes. Okay, so let me show you what happens to the startups that grow. This is 29 data from 2019. This is the beginning of 2019, really. 39 of these fintechs had become unicorns. A unicorn is a startup with a valuation of at least $1 billion. Okay, so more or less 40 startups in fintech were like this. Altogether, they were worth 150. Let's go to next year. This is 2020. Okay, this is mid 2020. Now we have already 66 fintechs, and they're worth 250 billion. Okay, and this is 2021, and now we have almost 100 fintechs that are unicorns, and altogether they're worth 400 billion. Now, what you see is that this sector, the segment of fintech solution providers, is growing really quickly. It was growing really quickly until COVID. After COVID, to be honest with you, these numbers are not growing equally fast, but nonetheless, they are reaching a level where we need to take them seriously and understand what they're doing. There are 2 or 3 things that I want to draw your attention to. The biggest threat that these kind of companies bring to incumbents, and so to the way we run financial services, has to do with the way they operate. They have a competitive advantage, or more than one, really. First of all, they are not launched with assets in mind. They're launched with customers in mind. So they use much more lean, customer-centric methodologies to develop solutions, because at the end of the day, they only need to do one thing right. For example, there was one company called TransferWise. They're now called Wise. They only did international transfers. Revolut, same thing. Yeah, similar thing. So each one of them has to do only one thing right for a small group of customers, usually millennials, now Generation Z, who are more mobile, they are more driven by technology. The second thing is that they do not have a legacy. So they don't need to protect 700 branches across Saudi Arabia. They don't have 700 branches around Saudi Arabia, so they don't have to protect it. They don't have to generate revenues to pay the utility bills for air conditioning in 700 branches. They don't have to pay for cleaning. They don't have to pay for anything because they don't have this legacy. Partly because they don't have a legacy, they also have very limited, very light assets. The cost of launching a startup these days is very, very close to zero. I'm exaggerating, it's not zero. But many of these things, many of these technologies are now available for rent. So the next point is that many of the technologies that fintechs use are based on cloud. Amazon Web Services probably is the most common one. It's not the only one. So the benefit of this is that there are no assets invested in servers. If you go to a traditional bank, I suspect it's the same in Saudi Arabia. If I go to a traditional bank in my home country of Italy or in the US or anywhere in Europe, really, probably you will find computers that have been bought and installed in the 70s. And they still run the software from the 70s with updates. But the updates are not revolutionary because they are still based on foundational software from the 70s. And so in some cases, even the 60s, to be honest with you. So the speed at which these companies, these fintech companies can grow and become better and faster, it's incredible. Finally, most fintechs are not heavily regulated. So this is a bit unfair because you have a lot of compliance issues, know your customer, anti-money laundering. You have to see your customer in person. You need to see them sign a paper. You need to see their ID. Well, this company, the fintechs don't really have to do that. They can get a scan of an ID and that's it, which is sometimes a bit unfair, but we will get to that point. Okay, let me stop for a second, just to make sure everything is clear so far. Do I speak too much, too fast, too slow? Is everything clear? Is there any questions, any comment? So I want to show you a little video now to give you a sense of what. Yeah, thank you. So I think that the video stopped. Okay, I hope that the video was clear because it's a video I really like because it highlights the way a fintech an insurtech, if you want to call it that way, but a fintech insurance company operates. The first thing you will see, you probably notice, is that you can get coverage for your insurance coverage without meeting any person, without going anywhere. You download an app and you can register online in a few seconds. You pay for it online and you're covered immediately. The second thing, maybe the video doesn't clarify this, but most of these is for housing. It's home insurance for your own residency or for Airbnb landlords that rent or host tourists. The second thing that's very interesting, I believe, is that when I, as a customer, when I need to make a claim, I don't need to speak with anybody. I just make a claim with the app. I send a photo, I send a video, and I sign. And the app, in most circumstances, releases the payment in a matter of a few minutes. Again, without the involvement of an individual or a human being speaking with the customer. This is quite unique. Later today, shortly, we will talk about how is that possible, because we talk a little bit about AI. It's not only AI, there's more to it, but I wanted to give you a sense. This is really different. This is really, really different than what you do in a traditional insurance company or in a traditional bank. So maybe I will give you a couple of 1 minute, not very long, just a moment to reflect on a couple of questions that I think are really, really important. Now, you've seen this startup, this insurance startup called Lemonade. I encourage you to think, hey, a solution like Lemonade, is it a threat to my business model? And if I think about my bank or my insurance and so on right now, and what I have, my assets, my capabilities, the way I run business and so on, is there anything I can use to mitigate the threat? And how should I mitigate the threat coming from this type of startups? Okay, I'll give you 30 seconds to reflect on it. In the meantime, I'll just turn on the AC. I just realized my AC is off. I don't think I can resist 1 hour like this. I'll be back in a few seconds. Okay, I hope that this helps, because everything I say means something different to each one of you. And so I really encourage you throughout the presentation, I really encourage you to think, hey, what does this mean for me? How does this work in my sector, in my industry, with my customers, and so on? All right, so I said earlier, and the reason I asked this question is to start thinking. I'll tell you what some of the answers I've heard. I do work with financial institutions quite regularly. I've done work with insurance companies. I'll tell you what a couple of them told me. One of them told me, and I get it, it's a very good point. One of them told me, Alessandro, you know what? It's fascinating. Well, Lemonade is fascinating as an example, but we make most of our money with life insurance or investment or other type of insurance. We don't really make a lot of money in home insurance. Many companies make a lot of money with car insurance. Say, sure, of course. But my question for you is, so if the same company like Lemonade offered car insurance in a similar way, would that be a threat? And they say, yeah, maybe, maybe not, because you know what, many of our customers still don't want this. And by the way, if small scale insurance companies like this provide car insurance, it doesn't matter, because we really have a huge market. And I agree, that's true. You have a good market, you have large, established relationships, good trust from your customers and so on. However, the argument that you don't do exactly what Lemonade does, and so it's not a competitor, that doesn't really work anymore. I told you earlier, the first rule of the game for startups, for fintechs, is unbundling, while the next thing they're doing is rebundling. What does it mean? What it means is that initially they focus on doing only one thing. But as soon as they become good at doing one thing, and they have a group, a user base of users that are, as I said, millennials, Generation Z, who really love them. They find the solution practical, convenient, portable, all of those, the good things that we can say about fintechs. Those fintechs, the next thing they do, they start saying, oh, I can offer another service, and then another service, and then another service. And so they can add and add and add more services until effectively they become a bank. Not yet, but they're getting there. Or they become a full-fledged insurance company, or they become a full-fledged investment manager or wealth advisor, and so on. So you see this happening over and over. Maybe the clearest indication that this is happening is that consulting companies, like you see here, Deloitte in the US, started offering a new service saying, hey, you want to be a bank? I'll help you become a bank. Why? Because as we said, these fintechs grow and they become the incumbents. So they start with one service, but then they add more and more and more, and eventually they want to become traditional banks. That's when the threat becomes real, yeah, for everybody. All right, let me move on to the next bit. So I'm not going to read all of these slides. You will have access to the slides so you can reflect on it yourself. But so this is a first level of reflection on what we said so far. We see these fintechs, they're changing the rules of the game. Have they been successful? And the answer is yes, they have. They have been successful at defining innovation in banking or in financial services at large. They change the rule of the game in that sense. Customers expect much more. Now you go to your bank and if you're used to paying with STC Pay in Saudi or Apple Pay, you go to your bank and say, why can't I have a similar service? So smooth, so quick, so cool, yeah. However, fintechs have not taken the business away from banks. Okay, this is clear. Banks are still there, or insurance companies or asset managers, you name it, right? And they have not really created an alternative world of finance. Not yet. Now, let's move on, because although I'm really excited about what the fintechs have been doing, I think that the most interesting rule book or game plan that we see lately is not that of the fintechs, but rather that of what we call the tech fins. What does that mean? Well, fintech means financial technology startups. Tech fins means technology companies offering financial services. So Amazon, Alibaba, STC. In the Emirates, it would be E-End, which used to be Etisalat, right? You name it. So technology companies are entering the domain, the arena of finance. How? Listen, you can look around, you can start researching, just look at what they do. To be honest with you, we can summarize this by saying the first move is always the same. The first move is payment. You have Apple Pay, you had Apple Cash before, Google Pay, STC Pay, Etisalat Pay. I mean, you just name it, right? The first thing that they do is that they make it possible for customers to pay with their portable device. And that's very interesting because they're already in the pocket of the customer, so it's easy to just add one service. But as soon as you start doing payments, the next immediate thing that happens, you start collecting a lot of data about the payments themselves. And so in many cases, when you have all this data, you can do something else that you couldn't do before. Loans. In many cases, this is specifically small business lending. Now, if you are in finance, you know how difficult it is for a bank to lend money to a small business. The compliance is huge, time consuming. It takes months to get the money disbursed. Small business owners, maybe, they don't have a lot of data. They don't have documents ready. They don't know exactly how to put together a business plan. So there is a lot of compliance, a lot of checks. It's expensive, it's time consuming. And most of the time, these loans are small in size. So there's little revenue to be generated by a bank. But for someone like Amazon or one of these tech fins, it's not so difficult to underwrite loans because they have access to an incredible amount of data that is not paper. It's data about historical transactions. And so it's much easier for Amazon to just automatically disburse a loan. I'll show you in a moment what another company does. It's not Amazon, but they do pretty much the same thing. Okay, so I said move number one, payments. Okay, more on payments. When you get the slides, you will see these are maybe a bit more updated, but it's not a completely different game plan. So Facebook, Meta, yeah, they also do payments. And now you get to the second and the third level in payment. For example, Amazon is doing biometric-based payments. Palm, you scan your palm on a reader, you pay with that. At some point they had payments based on Bluetooth technology and Wi-Fi technology, so you didn't even have to make a move to pay. You just needed to register. Apple plays an entirely different level of the game. They're trying to become an infrastructure payment infrastructure provider. So they want to take away the business of Visa and MasterCard. So many, many ways to look at this. I showed you earlier what an unbundled business model looks like. Well, this is the unbundling of a bank. So at the middle, in the center, in the middle, you still see the website of a bank. In this case, it's a business bank, Chase. But the tabs are still all the services that Chase for Business provides to its customers. And all around it, you see all of the equivalent services provided by Amazon. Amazon already provides effectively all of the services that a business bank provides. They don't have a banking license. I don't think that they're looking to obtain one in the nearest future, but they could anytime they want. And I want to draw your attention to what this means for banks, okay, or for insurance companies when they get there. Let me be super clear. The way these companies operate, because they have so many data, is different, is qualitatively different than banks. Look at this quote. This was published on Harvard Business Review a few years ago, when Professor Zheng wrote about the way Ant Financial, which is part of Alibaba, one of the big tech companies of China, how they issue small business loans, $50 or so, almost instantaneously without a big intervention of a human being, because they already have all the data. And so this is really, really interesting, because it takes away a major pain point for banks, but also a major segment of clients. And I want to add one more thing, actually two more things. If you can automate the issuing of small business loans, it means it doesn't cost you much. It's cheap to do these loans. It's also cheap to enforce them, because you lend money to businesses that already trade and transact on your platform. So they get paid on your platform. You can keep the money to pay it back. So they don't even have to come and pay you back. You can keep the money at the source. So you reduce your risk enormously. You reduce your cost enormously. And by the way, you know what? When you lend money to merchants on your platform, they will be using it on your platform to generate even more transactions. And so what is possible for a company like Ant Financial or Amazon or the likes? For them, they could give small business loans at zero interest. And banks could never do that. Why zero interest? Well, I said it, because the cost of issuing it are low, because it's automated. The risk is lower because they have a lot of data and because they have access to the wallet of these clients. And third, because anyway, they generate revenues somewhere else in the transactions. So this is a very, very bold move from competitors. Okay, listen, let me take a second of silence. I hope that everything makes sense so far. I just would like you, if you don't mind, to give me your insights so far. I created a poll if you want to answer. Let me see if this works. So it's an open-ended question. You can answer however you want. You can even just, take notes for your private use. You don't have to share on the Mentimeter. But so the question is, what are the threats of these large technology company that enter the financial services for you? Yeah, I see some of you said, yes, they pose a threat. I agree. These are big, emerging, and rapidly growing threats. Yeah, so you need to keep this in mind. Some of you says, STC specifically. Yeah, STC is doing incredible things in Saudi. Also, they're entering other spaces like gaming, cybersecurity, all sorts of other things. So it's not even clear what company they are anymore. Like all these large tech companies, they start doing so many different things. You ask yourself, hey, what do you do? And they say, everything. Nice. So this was a first, a second reflection, let's say. First, I showed you some questions. Now I gave you this poll. Let me now go back to the main part of the presentation, and reflect briefly on what instead incumbent companies are doing. So the financial institution, the traditional financial institutions. Back in the days, let's say 10 years ago, when fintech started, and then after a few years, tech fins began, but fintech started about 10 years ago, 2013, 2014, it was really already big. I lived in London at the time. I mean, it was incredible. Everywhere you went, there was some new financial service being released, tested, and so on. And I invited many of them to my classes. Actually, I was teaching a class on social innovation in finance, where I invited at least 5 fintechs every year. And sometimes I taught the course twice a year, right? So I met many of them. I spoke with many of them. And everybody knew back there, and that was the common belief, everybody knew that banks were not investing in financial technologies. They were just waiting. As soon as they noticed that one fintech was doing the right things, it was growing, the banks would acquire them. Yeah, the banks would acquire startups. Everybody believed that. But 2 things happened. The first one is that successful startups didn't let banks acquire them. They mostly became banks, or as we said earlier, they tried to become banks. Secondly, when traditional incumbents started acquiring fintechs, what they realized is that fintechs died. When you take a technology and all of its innovative way of running a business model and you put it inside a conservative, traditional, risk-averse institution like an insurance company or an asset manager, the brand new technological startup cannot survive, and most of them fail. And so what they started doing, the larger banks started doing, saying, okay, we cannot acquire fintechs because they don't want to be acquired and because it doesn't work for us. So they started doing their own. They started launching their own. I don't know exactly what's the situation in Saudi. I apologize for that. I can tell you in Dubai, for example, you have banks that launch. So Emirates NBD launched a smaller bank for millennials called Live. Okay, and you see similar game plans everywhere. So these incumbent banks or insurance companies start launching small services that are inspired by fintechs. Now, these are the large ones. Another response, another common game plan, I call it game plan, it's strategic reaction, if you can call it in a more technical way. This is true both for large, but even more so for mid-cap banks. They started partnering with fintechs and with non-fintechs. They started offering what we call banking as a service. I'll give you an example so it's easier to remember. For example, in the UK and in the US, I think that this is the American bank, what you see here, the American card. Uber issued a debit card for its drivers. Yeah, in the UK, they did the same thing with Barclays. But Uber cannot issue a debit card because it's not a financial institution. So what does it do? Well, it partners, in this case, they partner with Visa, elsewhere they partner with Barclays, elsewhere they partner with another financial institution. And do what? Listen, the financial institution provides the banking solution. So bank as a service. And the commercial company, Uber, puts the logo and takes care of distribution and marketing and other things. And so, in a way, what banks are doing, they're offering their banking license as a service to non-banks to provide solutions to their customers. I think in the long run, this will not work, but in the short run, that's what they do. One of the results of this, and we will come back to that shortly, is that financial services are becoming incorporated, we say embedded elsewhere. We'll come to the same slide later. I just wanted to make a connection between now and later, but we're not going to talk about it now. Okay? And finally, as we said, mid-caps, especially mid-capitalization banks, are really partnering heavily with fintechs. Why? Well, partly to accumulate more deposits, so generate more, more deposits, so have more assets under management. All right, let me take a super short break. Just make sure that everybody's with me, that everything is clear. Please go to the chat if there's anything you want to ask, or give me a thumbs up if you want me to continue, or whatever works. So just as a short recap, so far we said that there have been three major waves of financial innovation in banking. The first one were the information and communication technologies that made global banking possible. The second one were digital technology, digital transformation launched and promoted by big banks. The third one is digital transformation promoted by startups. We said the most important thing in all of this history is, well, in part, the technologies themselves. Absolutely. We're going to talk about them right now. But the other very important components that you need to be aware of and respond to are how do competitors play? How do they make strategic decisions? And so I told you, in this case, there are two very interesting types of competitors. One, fintech startups. Two, technology companies that become financial service providers. And three, of course, other banks. So what are fintech startups doing? They start by doing one service. They unbundle the business model. They have some advantages in serving customers. And then as soon as they lock in customers, they start adding new services. So they become banks in a way. The more threatening and an urgent threat is that of tech fins. So what do? They offer solutions for payments. They collect data. And then after they have data, they can provide additional services. For example, small business loans. But they can provide these services more efficiently at a lower cost than incumbents. And they also don't need to make money. They don't need to monetize them because they monetize those services somewhere else in their platform business model. Okay, these are the two big disruptive moves. And then, of course, you have incumbents. Incumbents used to think, oh, don't worry, when we see a good startup, we will buy it. It's not happening. So larger banks or larger incumbents are developing their own fintech solutions, and smaller ones are providing their banking or financial service license as a service to startups and non-banking companies. I hope all of these make sense, because now you understand this. It's time to move and talk about the two most important technologies yeah, that are transforming financial services. I don't want to spend a huge amount of time on them because I still want to talk a lot about the new trends, yeah, because that's also very important. But at least some basic elements about AI and blockchain. AI and blockchain have been growing and becoming much better over the past decade, and their application to banking is really, really obvious, right? So let me show you. At least I hope you all know what AI means and what AI is and what blockchain is. I'll explain briefly what they are, but then I want to highlight how they're used in banking and insurance and financial services at large. When you get the slides, you will see this decision tree published on the MIT Technology Review. It's been published also in Arabic, so if you want, you can find it in Arabic. It helps you understand what AI means in 2023. In 2023, AI is a technology, a set of solutions that uses large amounts of data to understand what these data have in common, so that the next time it's given one new data point, it knows what type of data point it is. I know I make it sound like super simple. It's not so simple, but it's the simplest way to look at AI. And so I want to show you and share with you 4 ways in which AI creates value for companies. In general, I will use 4 examples from known banks. Well, one of them is actually an insurance company, payment and insurance company, but the other ones are not. And then I want to show you what do these things look like when you transfer them to the financial sector. Okay. So one thing is this technology allows to automate, makes it possible to automate real-time response. So AI reacts in real time to whatever changing condition you want. And so when you read this, when you get the slides, you will read these examples. Some of them are hilarious, I think. The second one, and so in banking, what does this look like? For example, fraud detection. Now, fraud detection we've had for a long time for payments, credit cards, of course. Now, interestingly, there is, for example, this one called DataVisor. They have an AI solution installed in ATM, and there is a camera in the ATMs looking behind the person withdrawing money or doing the transaction at the ATM. And so this AI detects people moving behind and determines if they are about to assault the ATM, or there is activities that that you don't want that makes you suspicious, and so they can stop the ATM. If they suspect that someone is about to rob you, they don't give you money. It's very interesting because it reacts in real time to what's happening on that specific location. Now, I don't think that in Saudi you will find many of these. I don't think that your crime level is such that you need to respond to the threat, but elsewhere it can create a lot of value. Okay. Number 2, a little bit like Netflix. Every time you go on Netflix, there is a unique solution or suggestion for each one of you. Well, in finance, you can do something fairly similar when it comes, for example, to interest rates. Yeah, I remember inviting to one of my classes the early employees of Zopa. Zopa now has changed, but at the time, and I think they still do that part, to be honest, but at the time it was a lot more prominent. They lend money. It was a peer-to-peer lending platform. So I would go and lend and borrow money on Zopa, and Zopa would determine my interest rate based on so many data points. I remember the conversation I had with this man, and he told me, so where do you live? And I told him my address in London. He said, yeah, of course, but is that the right side or the left side of the street? I say, what difference does it make? Well, if you're on the right side of the street, we'll give you a better interest rate. I say, how do you do that? Because they have so many data about each borrower. And so based on big numbers, they can determine that if you live in a certain area, a certain side of the street, you're more likely to default on your loan. And so they charge you higher interest. It's that crazy. Yeah, it sounds crazy, but it's at that level. Now, I know that banks can't do that because you have different laws to respect. So that's one of the unfair things that we said earlier. Okay, insight. Insight is when you collect large amounts of data and you see that certain behaviors are correlated, something that human eye could not detect. So, for example, Alibaba, Alipay, has these billions of transactions collected every day, and they know that certain users spend more money than others, for example, repairing the screen of their mobile phone. So, okay, so what? The same users also buy skinny jeans or tight jeans. So those jeans that are a bit tight. Okay, and so what? So now if you're in China, you go buy a pair of jeans that are tight, Alibaba will offer you an insurance policy to repair the screen of your phone. It's a new product, was developed specifically for that target market. How can you do that? Because you have a lot of data and you cannot see that with human eye only, but the technology allows you to do that. Okay, final thing, the most obvious, AI does prediction. And so we know prediction of so many different things. So Princeton Blue, for example, predicts whether one of your borrowers is going to default. Based on what? They have data points that let them determine whether someone is going to have a medical emergency. So maybe they need to drop their job. It's so unexpected, right? So sophisticated and detailed. Anyway, again, what is AI? AI are technological solutions that look at large amounts of data and find what they have in common, and then they allow you do 4 things: respond in real time to changing conditions, develop hyper-customized solutions to your customers, generate insights, and make predictions. I mean, we can talk about AI for hours. I just wanted to keep it short, but these are the big takeaways. When you get the slides, you will see a few more examples of how this is used in financial institutions, but I think I gave you already a relatively short but powerful insight into how you use it. Now, when it comes to what we call blockchain these days, we're really talking about a ledger that is decentralized. And so we call these technologies DLT, decentralized ledger technology. A system is centralized if anytime an entity, a user, right, wants to transact with another user, they have to go to the center. So right now, if I want to transfer money digitally, even to my wife, she's in the next room. If I want to send money to her digitally, I have to go to the bank and the bank sends money to her. So this is centralized. A system may be decentralized if there are nodes where we can interact without necessarily going through that. Let me be more specific. When I send money to my wife, she actually has a European bank account. So most of the time I send money, my bank sends money to the SWIFT control system, and then the SWIFT control system sends the money to my wife's bank. Yeah, this would be something like decentralized. And finally, you have what we call distributed. Now, in a distributed ledger, a distributed system, I can send money directly to my wife without an intermediary. But this is a problem in online transactions, because if I can just send a digital instruction saying, hey, here is $10,000, hey, there's 10,000 more and 10,000 more and 10,000, who's going to check that I have this money? If there's no bank involved, how do you do it? So that's how we came up with the idea of a ledger. A ledger is a record, right? Every transaction ever made is written, reported on the ledger. And so on the ledger, you know if I have the money or not. And this ledger is publicly available. Everyone can know if I have the money or not, except that you don't know it's me, because there is a pseudonym, so not my real name. But when you look at my wallet, everybody has knowledge of whether I have this money. And so that prevents the problem of double spending, as we call it. So I can send unlimited amount of money without having an entity, a third party, who checks all the transactions. This is the way a blockchain works. I want to be a bit more specific. This is the way a blockchain works if it is open to anybody, like Bitcoin or most cryptos. It's public, it's shared. If you want to use it, there are some rules, you can use it. But who said that it should be like that? Maybe you need to get permission before you can even use it. Maybe I need to invite you before. It's what we call the permissioned DLT. Now, in a permission DLT, only the people that I decide or that we agree should be there are invited. Now that becomes a bit more interesting, because maybe you can think about various banks coordinating maybe with the SWIFT system or another system and say, wait a second, can we have a record, a public record, so we don't have to send money to each other via an intermediary bank or a correspondent bank, but we can just transfer money through this kind of blockchain? You can. Is it risky? Well, it's less risky. It's not very risky because it's not an open system. It's a smaller system. And listen, if you have a system that's not accessible to other stakeholders, it's not a blockchain. It's what we used to call a database. You have data yourself, you can access them yourself, and that's it. That's a database. So I want to give you 3 messages about what blockchain-like technologies, or DLT, decentralized ledger technologies, are doing in 2023. What are the big changes? And then we move on to talk about the trends. There are 3 major waves happening. Number 1, I'm sure you've heard, many banks, central banks, are experimenting or exploring really with digital currencies. Now, digital currencies are the equivalent of Saudi riyals or euros. They are issued still by a central bank, but now they don't need commercial banks because a central bank makes them available digitally through digital wallets. It's really, really disruptive. It's not ready. I think when it comes, it will affect a lot of the business models of traditional banks, and also the way we create money in a macroeconomic sense. Anyway, moving on. The second big, enormous change that these technologies are bringing is what we call digital assets or digital tokens. You must have heard about NFTs, non-fungible tokens. So what is that? A digital token, or a non-fungible token, or a digital asset, is the digital equivalent of something valuable that can be physical or not. So for example, I can say, hey, this is my phone. I break it down into 10 tokens. They're all the same. If you buy one of those tokens, you own 10% of my phone. And if you buy them all, then you own my phone. Now, maybe the phone physically is with me, but it belongs to you because you have the digital tokens corresponding to it. Now, this is not a very interesting example, but imagine doing the same thing with a company. Now, you can own shares of a company or bonds, yeah, in that way. These are fungible tokens. So my 10% is equivalent to any other 10% of the company. Non-fungible is when each token represents something that is unique. So the best example of fungible is money. Yeah, if you have a token that's worth 10 reals, then every other token that's identical to it will be the same. But if you own, for example, as a percentage of a house or a percentage of a piece of art, like a painting, now that is non-fungible. It corresponds to just that painting, that very one. You cannot say, oh yeah, I'll give you 10% of a different painting. That's not the same, okay? NFT. And finally, and this is how blockchains were initially imagined, thought of, and created, is to empower transactions between users. Yeah, I can send money to my wife without the bank. You remember the example I gave you. Yeah, that's how the blockchain was created. And this is what we now call Web3. So you will see many more of these solutions that allow individuals to transact with each other without an intermediary. All right, listen, I know we could be talking about these 2 technologies for days, but I wanted to keep this a little short so that we have time to start moving into, hey, what's changing? You say there are new players, there are new technologies, so what's changing? I want to tell you, there are many things that are changing. I selected 6 trends that are emerging, and then I would like you to maybe do a couple of take a couple of minutes to reflect on them. But before I do that, let me again summarize what I just said. I said that there are two major digital technologies that are growing and becoming more available and better really quickly, that are affecting financial services the most. The first one is artificial intelligence, more specifically or more correctly, machine learning. How does it work? It allows users to make sense of huge amounts of data so that it can empower one of 4 templates for creating value. What are they? Reacting automatically in real time, creating a hyper-customized service or solution to each user in specific moments in time, identify correlations between different data points, and finally make predictions about what is going to happen. What about decentralized ledger technologies? Well, decentralized ledger technologies allow banks and individuals or decision makers in general, users in general, to transact with each other without an intermediary. So making transactions faster and cheaper and equally safe, or sometimes even safer. And we said there are 3 big emerging trends here. Central banks are issuing digital currencies. There are digital tokens corresponding to the digital value representation of assets, which can be fungible or non-fungible, and then increasingly Web3 kind of applications, so direct user-to-user kind of applications. Okay, I hope all of this makes sense. As usual, if you have any questions, please let me know. We just have just over 20 minutes. I want to spend them to talk about the third important point. What is going on? What is changing? What is emerging right now? I'm not going to cover everything in a lot of detail. For example, this has been published by the World Economic Forum. Very, very interesting report. I don't think that everything that's written there is equally important to you today. So I'm just going to talk about the first 2. But hey, if you feel like doing additional readings, you want to know more, 2 things. 1, you can send me a message on LinkedIn. You can find me on social media. But then, alternatively, go look for the sources I've used. So I told you earlier, CB Insight is a good source that I've been using. The World Economic Forum is another one that I use a lot. I also use a lot of academic resources, but I don't think that you would be interested. So I'm keeping this a little bit more accessible. So what are the big disruptive impacts of these technologies on financial services? There's 8 of them. I'm going to mention the first 2, and then I mention a few different ones that are not included in this report. Listen, number 1, we call it cost commoditization. What that means is that increasingly we have solutions that can be offered to any bank for many things. What does this mean? Let's look at the first example you see there on the slide. The Monetary Authority of Singapore is creating a KYC service that works for all the banks. Now, that's interesting, right? It keeps costs low. It prevents you from doing duplicate work, and everybody has access to the same information. And that's great. But at the same time, if everybody has access to the same information, it becomes harder for any bank to gain an advantage based on this information. Maybe you had a service or an approach to KYC that made you better than the competition. You invested in it, you're faster, you're more accurate. And now no longer. Everybody is at the same plane, on the same level. So that's the negative implication. Another one, cost is a profit revenue redistribution. Listen, I'm just going to mention the second one you see there, betterment. So if you are a retail bank, probably you have huge deposits from your customers. And you're happy to have huge deposits because these deposits you lend at an high interest or you invest. And because you have good asset management skills, you make money out of them. And what do you give your customers in exchange? Well, almost nothing. Well, sometimes you give them a little interest, but very, very low. So the business model of many banks, retail banks, is founded on this. You take money in at very low cost and you invest it at good revenue, or you lend it out at good interest. Good for you. But now there are more solutions that make it very easy for users, customers, people like me, to invest money from my bank account easily and cheaply, for example, on ETF funds. And when that becomes so easy, increasingly you will see people like me who, instead of keeping money on my bank account, I will invest it that way. And if this becomes easy enough, then the amount of money that will flow out of the banks will be very substantial, and this will redefine, definitely transform the business model of most retail banks. Okay, so these are the first two trends that I think are really important. So when we talk about these technologies and the solutions, at the end of the day, we want to see what does this mean for the business model of banks and insurance companies and the like. Okay, now I want to move on and highlight maybe a couple of other important trends. One of them is that particularly tech fins and fintechs are not thinking of products anymore. You see the products down here. Let me change color so it's even clearer. And they're providing instead what we call intelligent services. So in a traditional financial service institution, you know, you provide insurance coverage or you lend money. But the truth is, it's not necessarily the case that someone wakes up in the morning and says, I really want to borrow money. And no one wants to borrow money. I want to buy a house. I want to buy a new car. And so the best way I can do that is to borrow money. But over time, these fintechs and the neobanks and so on, they're providing services that are different. They say, okay, you want to buy a new house? Let me help you. I will help you accumulate money. I will help you source the best mortgage you can find. I will help you put together the documents, and I will help you borrow money. Okay, we can provide intelligent services these days. But the end game is the next level. The next level is when financial services disappear somewhere inside other services. Now, there are still possible ways to play a role here. There are still ways to make money, but it's very difficult for a traditional company to remain, for a traditional financial institution to remain competitive here. So, for example, I want to buy a car. I don't want an insurance for it. I need it, but it's not like I want to go and find an insurance. And so what happens is that increasingly car showrooms and dealers give you cars as a service. So you rent a car, you pay a fee for the car, and the car comes with everything, including insurance, including loans, including all the financial services, which are embedded in the service and they disappear in the background. So if you go and buy a car tomorrow, you may not even know who you're borrowing money from or who you're paying insurance to. That all disappears. Now, this is a powerful, powerful transformation. That's, for example, Tesla does that. But think about Zolvers. Zolvers is a very powerful platform that helps manual worker, domestic workers in Latin America find jobs. Okay, I go there because I want to look for a job. I want to work and I want to get paid. Problem: I don't have a bank account. Why? Well, maybe I don't have paperwork. I don't have ID. I'm not registered. I want to be paid cash and so on. Okay, so how do you do this? Well, Zolvers provides workers with a bank account. So what kind of company is Zolvers? It's a job market platform. That's what it is. And it also provides a bank account. So the bank account disappears in the background. You create a profile on Solvers and you get a bank account. That's it. So once again, this is embeddedness. It's a financial service that disappears into a rich problem-solving solution. We'll talk about, so these are the first 4 trends. Yeah, the first one is cost commoditization, profit redistribution. Number 3 is the switch to solving problems, or the shift to solving problems. And more specifically, this happens with number 4, finance becomes embedded. I want to talk about number 5, which is already covered here. It's buy now, pay later, big trend. So this is again an example of when financial institutions offer banking as a service. We discussed it earlier. Yeah, they offer services to non-financial service providers. For example, in buy now, pay later. What's interesting here is that, consumer credit has always been there. Consumer credit means I go to a store, I buy a mobile phone, and I borrow money from my bank. So from you guys, I borrow money from my bank, or I use a credit card, and then I pay interest on it. The shop is really happy if I do that, because even if I don't have money to buy a phone, I will still do it. But then someone realized, wait a second, in this transaction, the one that benefits the most is the shop, because they make a sale. So why don't we charge interest to the shop? And that's what buy now and pay later does. I go to the shop, I buy a phone, I pay in installments, but I pay the price for the product at 0 interest. It is the shop that pays for the interest. So that's a big business model innovation. It's change in the way revenues are generated and who is your customer. Before, for consumer credit, the customer was B2B, B2C. It was the customer, really. But for buy now, pay later, the customer is the merchant. So it's a very, very substantial change. All right, we just have about just over 10 minutes. I want to cover the next couple of things. This is buy now, pay later again. Maybe just one more, and then we repeat this again, and then we start putting things together. You will see, you probably have seen it already, that when you are STC, when you're Google, when you are in everybody's pocket, and you start offering payments, now the payments are one of the elements, but then you can start adding more things. For example, Google Wallet lets you keep information about your underground card in the UK, in Europe, where they have underground. Or you can have tickets, airplane tickets. You can have boarding pass. You can have all sorts of ID. You can have driver's license. You can have COVID test. You can have all sorts of things. And then the more of these things you put together, so it's really like your wallet where you put those cards and those ID and business card. But the more you add these things, the more the app becomes not so much a payment device or a payment solution, and the more it becomes what we would call a super app, because it contains anything and everything potentially. And so it's like it's the interface between your physical world and your digital identity, and anything can go through it. And I think that this is the next big move for large tech companies and for financial players, because if you capture users and you bring them to do all of the things you see on the screen with your app, then the client's yours. You can monetize them in so many other ways. And so that's maybe the last of the trend. So there are more. As I said, I'm not covering them all. Another one that's becoming big is instant money transfers. So in many countries in Europe, it's for sure like that. In the UK, it was like that before. If I transfer money from my European account to my wife's account in Europe, the transfer is instantaneous. So she gets the money right away. Another thing is international payments are becoming more transparent, cheaper, faster, and most transparent. So that's another big trend. Open banking, so large amounts of data, anonymized, aggregated, and made available to competitors. That's another big trend, but hey, there are always big trends. So let's review quickly the ones I described here, because these are the ones that affect business models the most. Number one, cost commoditization. It's hard to stand out. Everybody is equally efficient when expensive services become commoditized. When certain solutions become available that are convenient and easy and cheap, the business model of those who depended on those solutions not being cheap may change. So in this case, we said, hey, why do I keep money on my bank account when I can easily invest it somewhere else? The next two come more or less together, but there is a shift in focus in the business model from offering services to creating solutions, where the focus and the value creating part of the business model is changing. And when you look at what this looks like, it's like, what company are you? Are you a marketplace, or are you a bank? Are you a car maker, or are you an insurance? Are you a store, a merchant, or are you a bank that offers consumer credit? These questions are becoming difficult to answer because business models are blurred. Okay, then specifically as an example within it, buy now, pay later, you transform your customer from the buyer to the merchant. Okay, and then the last one is wallets becoming super apps. So concentrating customers and creating value and monetizing in many, many different ways. So these are the three big topics I promised I was going to cover. We have a few minutes left, so I will encourage you to do one reflection, and then I will do the final takeaway. I told you the point number 4 is super short. It's only one slide, so I'll show it to you in a sec. But maybe maybe it's worth spending. I'll give you 2 minutes for this. I won't give you more. I don't need to see your answers or anything, but just for you to reflect. So we said so far, yeah. So some of the things we said is that financial services are being redefined in terms of the technologies that make them possible, and the providers that enter the market, and the new business models that are available. So they're changing. They're rapidly being transformed. So what are the emerging needs of your customers? And how do you create value to your customers addressing those needs? And then in a world where these technologies are becoming widely available and fairly similar, commoditized across providers, how will you stand out? What makes you better than others? You can't be cheaper than others because these things will be cheap for everybody. And finally, how do you persuade new customers to come to you? Maybe customers from a new generation. So these are the 3 key essential strategic questions that, you cannot answer them in 2 minutes. I'll give you one minute to reflect on them. I will go and turn off the AC because now it's really cold. It worked. And then I'll be back and we move to the wrap up and the conclusion. As usual, in the meantime, if you have any comment or any question, please use the chat or direct them to me, okay? So a few seconds to look at this. Okay, so these are the essential questions that you need to address and answer in order to make sense of everything we said today. I will give you the final quick recap, and then we will call it a day. Okay, so I said new competitors, new technologies, new business models, or these new trends, which are business model type of trends. And so we also talked here and there about new customers. And so at the end of the day, what I'm saying is that we're talking about new finance. Finance is going to be a new thing. Okay, so probably the biggest takeaway is this finance slide. Yeah. So you saw AI, you saw blockchain. We talked a little bit about the cloud, about super apps. Yeah, these are new technologies which allow financial service institutions to do things differently and engage with their users differently. By the way, there are also new players, new competitors, the fintech startups, as we described them at the beginning, the big tech companies that are making bold moves in this space. And with embedded finance, even non-financial service institutions are providing solutions. Like Uber is giving out debit cards. How crazy is that? You know, Tesla is giving car insurance. How crazy is that? We mentioned them in passing, but there are new customers out there. Okay, fintechs became very, very popular, especially among millennials. But then, of course, you have the next Gen Z, and then you have entire sectors of the economy, segments of the economy where banking solutions are not even available. So the unbanked. We talk about Zolvers, but there are many more similar users. And so addressing these users, these customers, is bound to be a completely new challenge. Okay. And finally, new business models and new rule books. This is how you make money. This is how you create value. This is how you compete. I'm not going to revise them or mention them all again, but the answer is all of these things together, when you have, you know, new customers, new competitors, new ways to create value and compete, and new technologies. I mean, at the end of the day, all that really means is that finance will be rewritten. The rules of finance will be rewritten. So it's a new finance. That's what we mean by it, or at least that's what I mean by it. Listen, this was a long conversation. I speak a lot. I apologize. I hope it was not too much, but I really wanted to cover a lot of ground. I really wanted to tell you as much as I possibly could. And so this concludes my presentation. We're actually just on time, so I'm not even over time. Knowing me and how much I like to talk, it was not hard to imagine. So I'm really proud of myself. I want to thank you all for being the audience today. I also want to thank the Financial Academy for inviting me and having me to talk about these topics that I think you could tell I really care for them. I'm really excited. I love these topics. And so I hope that you love them as well, and that this presentation gives you new ideas on how to, to prepare for the future of your industry. Thank you so much. And as we say in Italy, ciao, ciao.